Welcome everybody to Wall Street Reporter's next Super Stack live stream for today's that's September, January 7th, 2021. Well, Brad, I'm looking forward to it because I'm expecting such big things from you. I'm already looking forward to September when the stock might be $20. But okay, so welcome everybody to the live stream. We have with us Skylight Health, SHG on the TSX Venture, recently just uplisted to the TSX.V. Still in the over-the-counter. We have to get you to Nasdaq shortly, so it's still SHGFF over-the-counter. Prad, welcome back.
Hey, Jack. Nice to be back.
So, Prad, so the you're kind of starting off 2021 with a bang. Major news today. I think. Would you call today's acquisition announcement? I would say it seems to be like a transformational event.
It's transformational. Yeah. I mean, look, it's you excited. I'm excited. I was so excited yesterday. We've been sitting on this for months, and we haven't had a chance to talk about it publicly. We've hinted at it, talked about 8-figure size transactions. It's not the only one, but it's just exciting to be able to now have it out there, get on the show, talk about it. Put in front of our shareholders and investors what the real potential of Skylight Health is, and how last year was just, practice, and 2021, we start playing. So we got a lot more lined up, and we're just so excited now that this is out. Certainly transformative, but just the start.
Okay, so everything sounds good so far. So let's get into the details. So this deal is, this is from the highlights is basically this is going to bring your run rate up to 45 million revenues and 5.5 million EBITDA.
Yeah, and that's not talking any organic growth. That's just straight from the acquisition, coupled with the last few acquisitions that we've now announced and closed. That's not including organic. That's just purely as is.
Okay, so I think the key thing is like your kind of secret recipe here, the value add. I mean, this is not just like a roll-up play, which is the private equity guys. Your specialty really is taking these acquisitions and essentially 10xing their revenues organically through, you'll explain to them, but can you, and if you do this, so what does that mean? Does that mean you're going to do, 400 million in revenues based on what you have now?
Yeah, I mean, look, so we bring over 20 years of experience to this, right? And what we used to do really well is we would get drop shipped into clinics, and we would be told, you need to either make them profitable or you need to make them generate additional sources of revenue. And, we would be able to look at the cost structures, improve on them, usually see 10 to 15 to 20% improvement before we were done. But more importantly, we were able to find value-added services that benefited the patients. And these would be specialty services, paramedical services, allied health services, products, and we would find ways that would build on a patient's treatment plan. So if you were just a primary care patient, now you're getting these 4 or 5 other things. And from the business perspective, that means that you get to bill on those 4 or 5 other things as well, and it's all reimbursed through insurance. So when we look at every acquisition, and our thesis has been laser focused since we started doing this last year, we're buying primary care clinics, and in some cases subspecialty clinics, where we're going to bring tremendous value add to the existing business by enhancing what they already have, but then transforming it by bringing this multidisciplinary approach where it's a one-stop shop to healthcare. You don't have to go to these multinational or multi-location health networks to get the service. You can go to your community-based clinician and have all those services brought to you in-house. And we're going to do the same thing with the last 4 acquisitions we closed. We're going to do the same thing with this acquisition once it closes. And there's a chance that the revenue usually on average is about $150 to $200 per patient per year. That's the average unit economic on acquisition, sometimes lower. And our target on primary care alone is $1,000 per patient per year. And then once you add in multidisciplinary services, that could go to $3,000, $5,000. And some of our bigger competitors out there claim anywhere from $10,000 to $12,000 per patient per year on their price target. And so we have a long runway here of organic growth. The acquisition is just a starting point, but the way our model works is we're buying established practices, so we don't have to spend that 2 to 3 years to build a practice up from scratch. But we can take a practice where we know there's immediate room for improvement and growth. They've done a phenomenal job so far, but then we can add on significant growth from there moving forward. And that's really what we're going to do here with each one of these acquisitions, and from a capital allocation perspective, why every dollar we spend is going to be immediately accretive on day one, but then furthermore as we organically build up each clinic.
Okay, so give us the details on this clinic. I mean, the revenues, because the press release didn't really announce too much. I know there's like some confidentiality issues.
Yeah,
and that's going to be once you close, everything is once you close in the first Q1. I think you said. Yeah,
it's going to close this quarter.
This quarter, okay. So give us the details, revenues, where they're located, everything else, so people can imagine. Fill in the blank.
Yeah, so they've got over 6 locations. They're spread out throughout the state that we're acquiring it within. It's in one of the existing states that we are in today, so it further strengthens our position in that state as it is. They see upwards of over 100,000 patient visits per year, so it's a very active organization. They've got over 100 employees, over 30 healthcare providers that work for them, so it's a very structured company. On last year, they're expecting, I'd say over, but we'll be conservative and say 20 million in top line revenue. And that's been growing 15% year on year. So they've been seeing continuous growth within their own market. And on the bottom line, about $3 million in EBITDA. And again, I think that's conservative. I think that there's ways that we will continue to improve that further. So consolidated for Skylight now, we're sitting at about a $45 million annualized revenue run rate once this closes, and about a $5.5 to $6 million EBITDA run rate once this closes. And the beauty of the structure of this deal is, so we paid 4.7 times EBITDA. And if you look at the last few deals, I always claim is between 3 and 7. But we've been under the 5 times EBITDA multiple on all the acquisitions we've announced so far. But this deal is structured on both cash and debt. And so we only have to put up 40% of the cash. The other 60% comes through a seller's note. And that seller's note's it's a 3-year term, 8% coupon, but we can pay it back at any time with no penalty. And there's no further warrant kickers or stock kickers attached to this. So very clean deal, allows us to preserve cash on hand to bring on more acquisitions like this, so we can be significantly less dilutive on every acquisition and really get the value of the stock to grow. And on a cash balance perspective, we're still left with about $12 million once we close this transaction. So a lot of dry powder still to go and get 1 or 2 more of these kinds of deals. And again, we're looking at alternative ways of financing as well that can preserve that cash even further. So there's still a ton of upside in terms of what we have available to us. We brought the company out to a point where we haven't been burning capital, but now we're starting to make money, and that cash can be used to finance debt, can be used to finance growth, and we're going to be very aggressive moving forward here.
Okay, so how many after? Okay, you just raised some capital. You're doing this. How many, like right now, like after everything, like how many shares outstanding are you going to have?
It's about 170 million shares outstanding now.
Okay, so really you're kind of trading at, I don't know, 5x forward revenues. Seems like a pretty cheap number, no?
Yeah, I think we're at about 6.5 times forward revenues now, but still relatively undervalued compared to where you see other comparable healthcare peers on both the U.S. and Canadian side. But what we are starting to realize is that gap is closing as we continue to deliver. And one of the things that we're really proud of as a team is fundamental value drives the stock growth. So it's not about just putting the stock out and then hoping that we find something to hold it there. We are building that shareholder value by adding fundamental revenue, profitability, and teams behind the company. And so that's the other thing with this acquisition. We're getting a very structured organization. We're getting a lot of lessons learned, a lot of things that will help us nationally across our existing assets. All of the leadership and management are staying with the organization. And so we're very excited that, not only is this transformative from a P&L standpoint, it's transformative from an organizational standpoint. The bench strength here significantly increases, which allows us to be a lot more aggressive in the type of deals we look at, the size of deals we look at, and be able to ingest more of these type of acquisitions moving forward.
Okay, so we're going to open up to audience Q&A in just a second. I want to ask you just 1 or 2 more questions. Mm-hmm. Okay, so basically, you got, let's just call it, so 170 million market cap, roughly, 200 million market cap, roughly, more or less right now.
I think on the Canadian side, I think it's about 250 now, or I haven't figured out where the quote is today, but yeah.
So basically, you're gonna have 45 million run rate, and that's before you do kind of the magic here, the operational excellence, which the goal is, I guess, is to increase that to 10x is the kind of the target with all the stuff. But let's say you're only half right. Let's say it goes to 200 million, right? So let's say it goes to 200 million. So at that point, and in 200, now how long do you think it would take you to get to the 200 million run rate when you start doing your organic stuff? How long would it take to get there?
I mean, look, we're talking within a couple of years at most, and even within the first year, we'll start to see some significant improvement.
We're gonna see things like happen. In other words,
yeah. I mean, we're always cognizant of how organic takes a little bit more time than M&A does, and the reality is both happen in parallel. We're not stopping one and doing the other one, and so we're constantly working at it. Usually, the first 90 days, 180 days is getting to know the business, developing that cultural relationship together, and at the same time starting to piece together what that plan is going to look like, and then we start deploying that into sort of the second quarter of acquiring the group. And so we start to see this return within the first year itself, but again we're looking at transformative growth with each clinic group, and as we acquire, we're bringing the lessons learned from each clinic across the entire network, and so the rate of growth increases over time just because of the experience that's being put behind the addition of all those services. We're also bringing on great people. So like if you look at some of the last acquisitions we made, the Tennessee one, for example, great paramedical service. So same leadership staying with us, deploying that same model across all our other clinics. It leverages people to help grow the model. And that's ultimately the secret to how this model will expand and develop.
Okay, so in theory, I mean, I think so there's two ways I guess investors could be looking at this. I think this is kind of the key to understanding the stock or valuing the stock is, it's not so much the existing revenues, it's really they need to keep their eye on what is going to be the number when you add that kind of X factor, which is going to be, let's say 5x to 10x. So whatever the number is going to be 5x to 10x organic increase. So in theory, I mean, this could be right now, if you do nothing else, if you stop right now, you just do your magic, you'll be doing, let's say $200 million in 18 months, run rate. And, that's, what is that worth? 200 million revenue, the market would value what at 10x, $2 billion. I mean, that's, I think so. Well, I mean, because the market's paying for two things. One is the growth rate, and number two is the secret sauce. That's kind of the real value. I mean, it's the value add. So pretty impressive. Okay, so I guess the main thing is at this point is how fast can you grow? Because I think what investors are really looking for is how fast. And how far can these guys scale? Because then all of a sudden these numbers start extrapolating them out, and you could have a $5 billion market cap, in 12 months.
Yeah, I mean, look, this
pipeline in terms of acquisitions.
Yeah, I mean, look, what everyone should know is that this is experience led, and we are operators by training, and we are also strategic in terms of how we envision this company growing. So we're confident. I mean, when we ended last year, we talked about the pipeline, right? We said, look, there's over $70 million of deals in the pipeline. We're now closing on, 20 million, and there's still $70 million of deals in the pipeline. And we have enough dry powder where I can probably see one or two more of these deals coming in. And we anticipate to at least do a few more, deals this year. And so as we go through 2021, just on the M&A front alone, we expect to blow through or at least get close to that revenue run rate you're talking about on an exit basis for 2021. Now, a lot of that, of course, comes down to
200 million.
Well, I'm at least closer to the, breaking the 100 million mark for sure,
okay.
and going beyond that. And so we're pretty aggressive in terms of the deal pipelines we have in front of us, and just knowing what we have coming and what we have available to us gives us that level of confidence. Now, organically, once you start to see that turn of organic revenue, sure, that starts to get even further. But what I think people should know is the depth of the U.S. market. This is a very large market with a lot of market opportunities. There aren't a lot of players playing in the sweet spot of the market we play in with the deal sizes we look at. And that just enables us to get more access to deal flow. And, we haven't really done any outbound yet. Everything has been inbound. We've been working primarily with sell-side brokers. And so, having to now start leveraging potential buy-side brokers and identifying deals, that just continues to expand that deal pipeline even more. And so what we're looking to do is to build critical mass buy M&A at such accretive values and convert and organically grow. So we're building a business here that's going to demonstrate a lot of value in the next 12 months. It's going to demonstrate a lot of value in the next 24 months, and it's going to continue to demonstrate a lot of value for the next 2 to 3 to 5 years to come. And so, we're committed to this, and we've been in this from the start. We're happy to, tell shareholders that we're not selling, and we're happy to put voluntary lockups in our own stock just to show the confidence that we know that the value here is not just short-term, but the depth of the U.S. market here is going to enable significant growth for quite some time. And it's, we're just going to keep looking to get stronger and get bigger and deliver faster and deliver more sizable deals each time.
Okay. Yeah, I think again, there is the U.S. market is what is it's a couple of $1 trillion.
Yeah.
The healthcare market. So
yeah, that's right.
Yeah, I mean, there's more than enough room for a lot of players in the U.S. market.
Of course. Yeah, of course. Yeah, there's a ton of opportunity out there. Okay. And so, like I said, we're seeing some competition, not a whole lot. And like I said, with such a vast market, there's so many specialties, so many areas of focus. Whether it's private equity groups or other individual practices, we're very confident in what our pipeline looks like and what our pipeline is going to project to be over the next 1 to 2 years.
Okay, so realistically, I think so the key takeaway here is really that you could the 2021 you could come out of this year with north of 100 million revenues, 150 million, possibly
on an annualized basis. Yeah, of course, and that's going to be our target. That's what we're driving towards, and we're in January already, and we're about a third of the way there. So we're looking good.
Okay, so really, we're looking potentially at a $1 billion plus market cap, very easily if you get once you start hitting that hitting your stride, getting that run, people see that, they can extrapolate to $1 billion plus very easily, which is not it's not a big. That's actually a very small number in the healthcare world. So
it's a very small number. I mean, look at some of the other comparable healthcare companies. I mean, they're generating anywhere north of 700 to 800 million USD a year in revenue, and they still believe that they're still in their first inning. So, there's a lot of opportunity to do good in the U.S. market, which is what we're doing. There's also a lot of opportunity to do well in the U.S. market, which will be the result of doing good. And so, we're very opportunistic, and we want to chase that value. And I think what we have to offer is going to be quite differentiated from what the U.S. market has today.
Okay, so basically, it's. I mean, I'm looking at it as the stock could easily be 750 plus. I would say 9 months if the trajectory continues.
Yeah, I mean, look, Jack, our job is to deliver and execute, right? And we've done that all through 2019 in a way of profitability was a goal. We've done it through 2020 when we turned around and said growth is the goal. And like I said, we consider 2020 a warm-up, and 2021 is really where the game begins. And this is the first of many more to come. And we'll do what we do, which is, we commit, we'll deliver, we'll execute, and we hope that our shareholders continue to reward that growth and build trust in us as management, because that's ultimately what we can ask for at the end of the day is trust us to deliver and, continue to build the story together, and we'll all win at the end of the day.
Okay, let's jump into some audience questions. Okay, so the first question here is, what do you see organic growth hitting by Q4 this year? I'm not sure if does actually mean like, when do you
think in terms of run rate exit, in terms of where we hit in terms of organic growth? Yeah, that's a good question. I mean, look, our models call for sort of within that range. Again, a lot of what happens as part of last year exiting organically, we talked about a legacy network of clinics that are transforming. We have an existing base of patients that are converting, where right now the unit economics are 150. We expect that to get close to 500 to 1,000. So we are still on time with that. Some of the clinics start to roll out this month, and they start to provide those services to patients. And that is part of the organic growth we target towards the end of this year. But of course, as we go through the year, we're also acquiring, and there's organic growth in those acquisitions as well. So I think overall, there's going to be a much more valuable return in organic growth, both from the previous legacy business as well as from the transactions that we're acquiring and making enhancements and opportunities for growth within.
Okay. Who's your biggest competitor? Is there who else is doing what you're doing, like on a big scale like this?
So in the U.S. market, I mean, there are very few sort of public healthcare plays. You've got One Medical, you've got Oak Street Health. They're not typically M&A consolidators. Their focus is more in the area of organic growth, but they also focus on very different market segments. We play within a broad spectrum of primary and urgent care. We're on the fee-for-service side. We're targeting more of the population health in the suburban market. And we're obviously M&A focused. So typically for us, our biggest competitors today would probably be private equity groups who are also doing similar types of consolidation plays. But again, the value we bring is a much more liquid enterprise with more attractive multiples for raising access to capital and getting access to capital for making these acquisitions. And ultimately, our value at the end of the day is building a cohesive sort of independent network that differentiates itself from the larger health networks. And that's a really good way for us to show value to companies that want to sell to us and partner with us in their future growth too.
Okay, so that leads to a very relevant question. Do you have a target date for submitting a Nasdaq application? I think because again, just leading into what you're saying, I mean, if you are Nasdaq, this would be, all of a sudden, that would be very exciting for M&A. That really would put you on the map in the U.S. In the space.
Yeah, look, we want to make sure all the pillars to support a Nasdaq listing are there, and so it is in the cards. I can say that it's within reasonable distance away, and we can see it. But we're also working on creating those right pillars of structure, and we've been creating more opportunities to get exposure in the U.S. market. We look forward to potentially seeing some further research coverage and support coming from U.S. Banks. Getting in front of more institutional accounts, building that real, institutional support that will ultimately help a Nasdaq listing really mature and grow and get that value tied into what it is we're delivering on. And so we're doing both hand in hand. But like I said, it's very important to us to make sure that Nasdaq listing isn't just a one-time thing, but that we have the right team and strategy behind it that's going to help this value for shareholders really, rocket off and become something that we're all looking forward to seeing.
Yeah, I mean, it's not. I mean, it's not just being on Nasdaq because all of a sudden now you're in a big pond. But at that point, you're going to have, the story is going to have to keep accelerating the pace.
Correct.
The scale has to be, is going to. But really, once you're on Nasdaq, all of a sudden, then you're really, for institutional investors, then basically you're like right there with 1M, Oak Street. So you're going to be one of those key stocks that they're looking at.
Yeah, and look, and Nasdaq loves these kinds of stories. I mean, look, we've seen it very successfully. Like one of our largest institutional private equity investors, Merida Capital. And Merida Capital is also a big investor in GrowGen. And if anyone has identified the GrowGen story, I mean, QX to Nasdaq listing $3 to now I think they're $44, and it's a consolidation, strategic acquisition and organic growth within a different retail market, but very similar to our thesis. Following in the sort of footsteps of our bigger GrowGen is acquiring practices, making them, enhancing them, making them better, but buying them at very attractive values so that you could do this all day long. And so you're seeing that reactiveness come in a market like Nasdaq to a story like GrowGen. Very similarly, we look forward to building a similar capital market strategy, but one that's going to appreciate the same story that Skylight Health is building within a healthcare market.
Okay, okay. So you said you can do this rinse, wash, repeat process scaling up. So I guess my question is what's in the way of you just exploding the next 6 months? What are the constraints? What would stop you from doing 500 million in acquisitions, which is actually, it sounds like a lot in this world, in the TSX, OTC, but in the US healthcare world, that's, again, it's nothing. So what's in the way of you doing 500 million in revenues of acquisitions the next, let's call it 9 months?
Well, look, I think if we opened up all sources of deal flow, we will find them. They will be there. But like anything else, you got to make smart acquisitions, and we don't buy everything we see. We usually say no to most and say yes to the ones we like. And it takes time. Larger the deals, you want to spend the time evaluating them. You want to make sure they're accretive. At the end of the day, I believe we're here where we are today because we're disciplined in how we allocate our capital and what we buy them at. And so we're going to stay committed to that because, like I said, Jack, ultimately at the end of the day, it's trust. They got to have trust. People have to have trust in us as management to deliver on the promises we make. And so we're going to make sure that those deals line up with our metrics. They're the right deals. They're accretive. We know we can drive organic growth after the fact. And so that diligence process needs its own time. You can't take 9 women and make a baby in 1 month, but it's an idea that says, let's accelerate, let's grow. But each of these acquisitions brings on such an incredible team that we're getting faster, and we're getting better, and we're getting more impactful with the kind of deals we can close.
It's a real snowball effect. I mean, as you add more people, more talent, acquisitions. It's sort of that virtuous cycle, I guess they call it, the flywheel, right? That's the new thing that they're using in the tech world, the flywheel approach.
Look, we're going to move fast, but we're going to move smart. So,
Robert is asking, so all the clinics that you're acquiring, when will they convert to, I guess, Skylight full branding, or?
So with the acquired clinics, not always the case. And that's part of the strategy. Is we don't want patients to feel like they're part of one large corporate infrastructure. We want that community feel. We want the patient to walk in, know the staff, know their doctors, feel that one-on-one approach with their providers, have that physician autonomy. So acquired clinics, not always the case. Legacy clinics that are converting over into primary care, you'll start to see news around that this quarter. So that is in process. We committed to that last year in Q1. We are on time. It is happening, and we'll start to put some news out across that this quarter about those conversions of clinics and through the course of 2021.
Okay, we got a bunch of questions on the... Okay, hang on a second. Wait, Fred. Okay, stand by a sec. We had a little technical glitch here on Periscope. We're on multiple. Okay, so Periscope. There's an issue with Twitter and Periscope right now. Okay, a bunch of people asking about the subscription product you announced in December. That was the $199. How do you refer it? It's sort of like the $199 healthcare package.
So it's really a product that's targeted for the under and uninsured, right? So it's our solution to target the uninsured market, and it's a $199 a year subscription program that gives you unlimited access on telehealth to a provider for urgent care needs, and you can pay for it monthly, or you can pay for it annually. And I don't know if you saw recently, but the 3-year project Haven just got disbanded, and Haven, which was sort of call it the billionaire's approach to solving affordable healthcare. That
was Amazon, right?
Amazon, Berkshire, and JP Morgan, correct. And so, I think it really draws a need and shines a light on what needs to be done to be able to bring affordable healthcare access for patients. And so, we're very excited about what the program stands for. We continue to work through, the ability to bring this product to more patients. We're continuing to sign up new patients. And so the experience will lead to something great and big this year. We'll continue to keep building on that. But as a product, as a market, it is a very real need. Others are trying to solve it, haven't been successful, I don't think, at it yet. And, we believe we are, because again, this is based on a model that for us is relatively tried, tested, and true.
Okay. I think there was some sort of issue with this Periscope, and a lot of questions just disappeared. So some questions I was going to get to disappeared. Blame it on Twitter. It's not us. Okay. There is somebody saying something about, okay, so there's a lockup. Can you explain the lockup that's in place? The share lockup.
Yeah. So, look, there's a certain level of commitment that we will always demonstrate as management, as founders. We've got large positions in this company, and we've never sold a single share to date. And so we're more than happy to communicate that. And we're more than happy to put it on paper. Let's put our money where our mouth is. We believe we know the story is going to go somewhere. We know where the value is going to keep coming. We want to show that value to shareholders. So, Cash, myself, the 2 founders of this company, we agreed. It's fine. We have no issues putting it out and saying, no sell. We have no interest in selling, and it's not like we're going to anyways, but I know it provides a sense of confidence for shareholders to see that as well. So that is something that we're, always continually preaching to shareholders and investors, to say, we are committed. We've always been committed, and we're going to keep showing that in whatever way we need to.
Okay. Let's kind of wrap up here. I know we're probably going to have you back on very shortly, hopefully with some big news. So So right now you have this deal that's going to basically close in the next few months, roughly. Maybe.
Yeah, by the end of the first quarter for sure. Sooner is our goal.
Okay. What else do you have that's kind of what other kind of news flow can we expect? For the next month or so.
Yeah, I mean, look, we're deepening our bench, so there's certainly going to be some experienced assets coming on board that are going to continue to further strengthen our vision and further strengthen the execution of our plan. We obviously have the upcoming conversion of our existing clinics. That's going to be news that shareholders can certainly look forward to. We're going to want to talk about some of this organic growth and development and how this is starting to work within the practices. So that's going to be something that we're certainly going to want to bring to market as well. And like always, we are constantly finding new partnerships, new strategies, and new growth models. And so that's we're nothing short of busy. That's for sure.
Okay. This goes back to subscription. So that $199 subscription. I get somebody's asking like how many people have you? A few people have asked how many have you signed up. I think you just really started that. So when can we expect to see some numbers announced there?
Yeah, I mean, I know we have at least at the time being. So all the legacy patients that were there as part of the previous business have all been transitioned here now. So there's well over 100,000 patients as part of the program. In terms of new signups that are continuing to happen, those stats continually change week on week based on different metrics that we do. But I know that we're upwards of at least 1,000 or more patients at the moment. So, and that's going to continue to expand as we build on new strategies and expand it to more markets.
Okay. So Brad, I'm going to ask you our favorite question, which we always like to wrap up with. At this moment in time, based on all the news, this acquisition, top 3 reasons that in your opinion, for investors to consider SHG stock today?
Sure. So trust in management. We've done this before in the past. Experience in building and enhancing and improving and running profitable medical clinic operations, and a team that is just phenomenal at executing and delivering. I mean, I'm just here, the guy to talk, but it's the folks behind me that ultimately do what we need to do. And so, team and management, certainly number 1. Number 2, opportunities are endless. We're talking about a massive market, a multi-trillion-dollar market, where there's a huge opportunity for consolidation, over 70% in a fragmented space, and we're demonstrating accretive, attractive prices and the ability to grow on each of these deals. And then lastly, strong base of operations to build on. I mean, we've strengthened the company financially significantly. We've improved on our balance sheet. We're in a great position from a cash flow perspective, and further moving forward, we're leveraging new forms of capital to be able to finance growth and bring more value to shareholders in a relatively less and less dilutive fashion. So that's certainly 3 key reasons why I would put forward that, and we're just starting. That's what I keep saying. It's just the first week of January.
Okay, I'm going to ask you one last question. So if you had to kind of use one word to describe 2021 for SHG, what would be the one word?
I use the word execution. It's time for execution. We put a plan forward last year. We talked about the opportunities. It was about positioning ourselves for realizing truly explosive growth, creating a market share in the U.S. that defines Skylight Health as a prominent player in the U.S. healthcare space market. 2021 is about execution.
Okay, perfect. Brad, thank you. We're going to have you back very soon, and we're looking forward to hearing about some more huge acquisitions. We need big acquisitions. I think that's what investors are looking for.
Well, like Jack always has.
That's what they want. That's immediately by next week.
I look forward to seeing you back on the show, Jack. I really do.
Brad, thank you again.